The structural bedrock. Think about trying to build a massive glass skyscraper on top of a soft swamp. You can spend millions of dollars buying luxury finishes. The very first time a minor storm rolls through the city, the entire structure will tilt and sink into the mud because the base was completely hollow. This is exactly what happens when you throw your hard-earned cash into volatile tech stocks or cryptocurrency before establishing a basic financial buffer. Recent data shows that a staggering number of people possess less than $500 in ready cash for unexpected life events. That means a single flat tire or a broken tooth can completely destroy their entire financial universe. An emergency fund acts as your ultimate psychological shield against the unpredictable nature of reality. Wealthy individuals understand that liquid cash primarily provides short-term option value and immediate safety. You should aim to stack your first $1,000 with absolute urgency to cover the baseline friction of daily life. Once that baseline exists, you can scale that buffer up to one full month of living expenses before pushing onward to a comfortable 3-month cushion. Having this liquidity prevents you from being forced to liquidate your long-term investments during a sudden market downturn. It ensures that you remain a highly resilient participant in the market at all times. Once your baseline safety net is firmly established, your immediate focus must shift toward wiping out high-interest consumer debt. Carrying a balance on a credit card that charges 22% annual interest is a form of financial hemorrhage. Mathematically speaking, paying off a high-interest loan delivers a guaranteed return that is exactly equal to the interest rate of that loan. Finding a consistent, guaranteed 22% return in the stock market is an absolute statistical impossibility over the long run. Aggressively paying down these toxic balances represents the most efficient use of your capital at this stage. You can think of consumer debt as a massive anchor dragging behind a speedboat. You can rev the engine as hard as you want and burn through all your fuel, but you will progress slowly because the friction is simply too high. The smart move is to line up your debts from the highest interest rate to the lowest interest rate and attack the top target with every extra dollar you can find. This method maximizes your mathematical savings and frees up your cash flow for the real wealth building steps ahead. Once you clear this hurdle, your money finally starts working entirely for you. Have you ever noticed how the most stressed out people always seem to be chasing the latest investment fad? They are frantically checking their phones for stock charts while ignoring the massive bills piling up on their kitchen counters. This backward approach creates a loop of permanent anxiety where every gain is instantly swallowed up by compounding interest owed to a bank. True financial freedom requires a clean slate where your income belongs entirely to you. Clearing the deck gives you the leverage needed to play the game of investing with complete confidence. The efficiency zone. The moment your high-interest obligations are completely wiped out, you enter the arena of maximum efficiency. This is where you leverage your career to capture the easiest wealth multiplier available in the modern financial system. If your employer offers a retirement plan with a matching contribution, you must contribute the exact amount required to trigger that full match. This arrangement represents a literal 100% immediate return on your capital before the money even touches a single stock or bond. Leaving an employer match on the table is the economic equivalent of walking past a stack of free cash on the sidewalk and refusing to pick it up. Imagine a nightclub bouncer who hands you an extra $100 bill every single time you walk through the door just for showing up. That is precisely what corporate matching programs do for your long-term net worth. Even if you still have moderate debts like a low-interest car loan or a student line of credit, the sheer math of a 100% match overrides almost everything else. You want to automate this contribution directly from your paycheck so you never even see the money hit your checking account. This simple habit turns wealth accumulation into a background process that runs silently while you sleep. After securing every single dollar of free corporate matching money, your next destination is an individual retirement account. These specialized accounts give you total control over your investment selection with incredibly low fees. Many corporate retirement plans suffer from a limited selection of expensive mutual funds that slowly eat away your returns over time. An individual account allows you to bypass these corporate fee structures completely and purchase dirt-cheap index funds that track the entire stock market. Minimizing your investment expenses by a single percentage point can translate to hundreds of thousands of additional dollars in your pocket by the time you retire. Choosing between a traditional account and a Roth account depends entirely on your current career stage and future earnings expectations. Traditional accounts grant you an immediate tax deduction today, meaning you defer your tax obligations until you withdraw the money decades down the road. Roth accounts require you to pay your taxes up front, allowing your investments to grow completely tax-free forever. If you are a young professional currently sitting in a lower tax bracket, paying the tax today is an incredibly smart bet. You lock in a low rate and ensure that every dollar of future growth belongs entirely to you. Have you ever paused to calculate the long-term impact of investment management fees? A seemingly tiny 2% annual fee can quietly consume nearly half of your total investment portfolio wealth over a 40-year working career. Wealthy individuals are notoriously protective of their capital and refuse to support fund managers who underperform the broader market. By utilizing an individual retirement account, you become the captain of your own ship and select the exact vehicles that align with your long-term objectives. This shift in control marks your transition from a passive consumer into an active wealth accumulator. The Advanced Shield. Once you have fully maximized your individual retirement options, you gain access to the most powerful tax vehicle in the entire financial code. The health savings account is frequently misunderstood as a simple medical rainy day fund, but the wealthy treat it as an elite investment vault. This account offers a unique triple tax advantage that is unmatched by any other vehicle in existence. Your contributions are fully tax deductible on the way in, your balance compounds completely tax-free over time, and your withdrawals remain entirely tax-free when utilized for qualified expenses. It represents a flawless defensive shield against the corrosive impact of taxation. The ultimate strategy with this specialized account involves a clever exercise in patience. You should aim to cover your current minor medical expenses completely out of pocket using your regular income while leaving the account balance untouched in the market. You must preserve every single medical receipt digitally because there is no expiration date on when you can claim a reimbursement. This allows your capital to compound aggressively in broad market index funds for 20 or 30 years. Decades later, you can withdraw that massive accumulated sum completely tax-free to reimburse yourself for past expenses. After exhausting your triple tax advantaged options, you return to your workplace retirement plan to maximize your remaining contribution limits. At this stage, your income is likely rising and you need to shield as much cash as possible from the highest tax brackets. Pushing your contributions to the absolute legal limit allows you to dramatically lower your adjusted gross income today. This strategy ensures that a massive portion of your compensation goes straight into your asset column and minimizes your tax obligations. It accelerates your compounding momentum to a level that standard savers rarely ever witness. The final destination for your capital is a standard, fully taxable brokerage account. This environment lacks the strict contribution limits and early withdrawal penalties found in retirement accounts, giving you ultimate liquidity. You can deploy this capital to build a bridge fund for early retirement, purchase real estate, or fund major lifestyle milestones. The catch here is managing the ongoing tax drag from dividends and capital gains along the journey. Wealthy investors counter this drag by holding highly tax-efficient index funds and practicing a strict buy and hold philosophy. Think of a taxable brokerage account as the open ocean of the financial world. There are no boundaries, no caps, and no safety nets to stop you from exploring any asset class you desire. You can accumulate vast holdings of high-quality equities that can eventually be passed down to future generations with an adjusted tax basis. This liquidity gives you the ultimate power to walk away from any job or business venture whenever you choose. It transforms your accumulated capital into a perpetual freedom machine that funds your ideal lifestyle without restrictions. The mastery of monotony. The real challenge of this entire wealth sequence has absolutely nothing to do with complex mathematics or brilliant stock picking. The harsh reality is that building true financial freedom is an incredibly boring, repetitive process that requires massive emotional discipline. Most people fail because they suffer from a desperate need for constant excitement and immediate validation. They want the thrill of watching a speculative asset double overnight so they can brag about it to their friends at a bar. They completely lack the stomach for the quiet monotony of automated index fund contributions and systematic debt repayment. Society constantly bombards you with images of overnight success stories, eccentric crypto millionaires, and young trust fund heirs living lavish lifestyles. This toxic exposure distorts your perception of reality and makes the foundational steps of wealth creation feel painfully slow. You must accept the fact that your financial journey will likely feel entirely uneventful for the first few years. Compounding interest behaves like a snowball rolling down a massive mountain. mountain. At the very top, the gains are so small that they are barely visible to the naked eye, but if you keep it rolling, it eventually transforms into an unstoppable force. Your peer group will likely look at your lifestyle and assume you are falling behind because you are not participating in the consumer arms race. They will be busy financing luxury vehicles, upgrading to oversized apartments, and wearing expensive designer labels to maintain an illusion of prosperity. You must develop the rare ability to separate your self-worth from your material possessions. True wealth is entirely invisible, consisting of the assets on your balance sheet that buy your time and your autonomy. Looking rich is the ultimate trap that prevents you from ever actually becoming rich. The payoff. This brings us right back to our quiet department store janitor who left behind an $8 million fortune. He succeeded because he executed this exact wealth sequence with absolute perfection for decades without ever seeking attention or applause. He secured his foundation, avoided toxic consumer debt, maximized his available accounts, and allowed time to do all the heavy lifting for him. Building an extraordinary financial legacy is fully achievable on a standard income. Success requires the discipline to follow the sequence, automate the process, and stay out of your own way. If you want more strategies on how to optimize your capital and master your financial future, make sure to hit that subscribe button and drop a comment below. Until next time, keep grinding.